Did you know that most people believe they need lots of money to start investing? That's one of the biggest myths keeping people from building wealth. Hey everyone, this is Finance Inspector today. We're separating fact from fiction so you can start your investing journey with confidence. Welcome back to the channel. Whether you're fresh out of college, starting your first job, or simply looking to finally take control of your financial future, this video is for you. The world of investing can seem intimidating at first, filled with jargon, complex strategies, and contradictory advice. But here's the truth. Investing isn't as complicated as Wall Street wants you to believe. Today, I'm breaking down the 7 most persistent investing myths that keep beginners on the sidelines, costing them years of potential growth and compound returns. Before we dive in, make sure to hit that subscribe button and notification bell so you don't miss any of our financial literacy content that could literally change your financial future. Now let's get myth-busting. The internet is flooded with investing misinformation. Between Reddit forums, TikTok financial gurus, and your uncle's hot stock tips, it's hard to know what's actually true. And the stakes are high. Making decisions based on myths can cost you thousands or even hundreds of thousands of dollars over your lifetime. In fact, a recent survey found that financial misinformation costs the average American over $1,200 per year in lost opportunity or poor financial decisions. That's why today we're tackling these myths head-on with evidence-based information you can actually trust. This is perhaps the most harmful myth out there. You absolutely do not need to be wealthy to start investing. Here's the reality. Many brokerages now offer zero minimum investment accounts, fractional shares, let you buy portions of expensive stocks like Amazon or Google for as little as $5. Index funds and ETFs can be purchased for under $100 in many cases. Micro-investing apps allow you to start with just your spare change. I started my investing journey with just $50 a month while paying off student loans. Today, those early investments have grown substantially, not because I had a lot to invest, but because I gave my money time to compound. Remember, investing small amounts consistently beats waiting until you have enough money. Time in the market is more powerful than timing the market. When someone says investing is just gambling, I know they fundamentally misunderstand how markets work. Here's the difference. Gambling is a zero-sum game with predetermined odds that favor the house. The longer you play, the more likely you are to lose everything. Investing in productive assets like stocks, on the other hand, represents ownership in real companies creating real value in the economy. While short-term price movements can seem random, the overall trajectory of markets has been upward over any 15-plus year period in history. The S&P 500 has returned about 10% annually on average since its inception, around 7% after inflation. No casino game offers positive expected returns like that, especially over decades. Smart, long-term investing isn't about picking hot stocks or timing the market. It's about capturing the overall growth of the economy through diversified investments. Wall Street profits from making investing seem complicated. The reality? The most successful investing strategies are often the simplest. Studies consistently show that most active fund managers, literal financial professionals, fail to outperform simple index funds over the long term. According to S&P Dow Jones indices, over 90% of US large-cap funds underperformed the S&P 500 over a 15-year period. What does this mean for you? You don't need to analyze balance sheets, read earnings reports, or have an economics degree to be a successful investor. A simple portfolio of low-cost index funds that track the broad market can outperform most professional money managers. Warren Buffett, arguably the greatest investor of all time, has repeatedly recommended that ordinary investors simply buy a low-cost S&P 500 index fund and consistently invest in it over decades. That's hardly rocket science. Yes, the stock market experiences volatility. That's the price of admission for higher returns. But risky depends entirely on your time horizon. If you need your money next year, then yes, the stock market is risky. But if you're investing for retirement decades away, the biggest risk isn't market volatility. It's not investing at all and missing out on growth. Consider this. Despite every crash, recession, and correction over the past century, including the Great Depression, Black Monday, the 2008 financial crisis, and the COVID crash, a diversified stock portfolio has still delivered positive returns over any 20-year period. The real risk is inflation eroding your purchasing power if you keep too much money in cash. Over the past 50 years, the dollar has lost over 85% of its purchasing power, while the stock market has increased more than 7,000%. For beginners, the answer isn't avoiding stocks. It's understanding your time horizon and diversifying appropriately. Buy low, sell high sounds simple enough, right? The problem is, nobody, not even the professionals, can consistently predict market tops and bottoms. A famous study by Morningstar found that if you missed just the 10 best days in the market over a 20-year period, your returns would be cut roughly in half. And unfortunately, those best days often come right after the worst days, when most market timers are sitting on the sidelines. Instead of trying to time the market, time in the market is what builds wealth. Dollar cost averaging investing a fixed amount regularly regardless of market conditions removes the emotional component and has proven more effective for most investors. I've seen countless clients panic sell during downturns, locking in losses, then sit on the sidelines during recoveries, missing out on gains. Don't make this expensive mistake. Thanks to movies and social media, many beginners think successful investing is about finding the next Amazon or Apple. While hitting a home run with an individual stock feels great, building wealth consistently is more about your overall asset allocation than picking winners. Studies have found that more than 90% of your investment returns are determined by how you allocate your assets across different investment categories, stocks, bonds, and so on, not by which specific securities you choose within those categories. For beginners especially, a diversified approach using low-cost index funds or ETFs is far more likely to build wealth than trying to pick individual winners. Even professional stock pickers get it wrong most of the time. A study found that only 4% of stocks accounted for all of the US stock market's gains over and above Treasury bills from 1926 to 2016. Instead of chasing the next big thing, focus on building a diversified portfolio aligned with your goals and time horizon. In the age of investing apps and real-time quotes, there's a dangerous belief that good investors constantly monitor their portfolios. The opposite is true. Checking your investments daily often leads to emotional decision-making based on short-term fluctuations. Studies in behavioral finance show that investors who check their portfolios less frequently actually achieve better returns on average. Set up automatic investments, review your portfolio quarterly or semi-annually, and make adjustments based on life changes or major market shifts, not day-to-day movements. Remember, investing is a marathon, not a sprint. The most successful investors I've worked with are often those who set up a solid plan and then largely forget about it, allowing compound interest to work its magic over decades. Here's the truth that Wall Street doesn't want you to know. Successful investing isn't about being the smartest person in the room or having special knowledge that others don't. It's about consistency, patience, and emotional discipline. The biggest obstacle between most people and investing success isn't market volatility, economic uncertainty, or lack of funds. It's their own behavior and beliefs. The myths we've discussed today aren't just innocent misconceptions. They're barriers keeping millions of people from building wealth. By understanding that investing is accessible, not gambling, doesn't require expertise, works best over long periods, doesn't depend on timing or stock picking, and requires patience rather than constant attention, you've already overcome the biggest hurdles most beginners face. Let's quickly recap the myths we've debunked today. 1. You don't need a lot of money to start investing. Even small amounts grow with time. 2. Investing is not gambling. It's owning pieces of real productive businesses. 3. You don't need to be a financial expert. Simple strategies often outperform complex ones. 4. The stock market is not too risky for beginners if your time horizon is long. 5. Timing the market is not necessary. Consistent investing works better. 6. Picking winning stocks is not the key to success. Asset allocation matters more. 7. You don't need to check your investments daily. Patience pays off. The most important step is simply to start. Every day you wait is a day of potential growth lost. Remember, the best time to start investing was 20 years ago. The second best time is today. If you found this video helpful, please hit that like button and subscribe for more investing content designed to help you build real wealth. Drop a comment below sharing which myth surprised you the most or what other investing topics you'd like me to cover. Remember, financial literacy isn't taught in most schools, so sharing this video could help someone else break through these harmful myths. Hit that share button and let's spread real financial education. Until next time.